maybe hide out in one space or another. Catherine Burton joining us right now, Bloomberg News reporter. A great story on the Bloomberg terminal about Tiger Global. A lot of us, of course, when they started, looked at them as, well, just a traditional hedge fund, if you will. And they've not had a good run at that, at least not as of late, but they have found, I guess, maybe some solace in the VC space.
That's absolutely right. They started out in 2001 as a hedge fund, and then over the years they've been growing their investments in venture capital, especially in the last 2 years.
Kathy, I mean, this is about things that didn't work and maybe things that don't work. And I love in this story, your exclusive, that talks about how everybody is really jealous of the returns that you see among the venture capital world and the private equity world, that people are really looking for those outsized returns.
That was absolutely true, especially in 20 and 2021. There was a ton of money that was raised because valuations just went crazy. And then this year, there's been some funds, including Tiger Global, have had to write down some of those venture investments, but those write-downs come much fewer than you do in the public markets, for certain.
That's the what I really wanted to get at, Kathy, is the idea that, you know, just because these are private investments and they're not, you know, traded daily or traded a few times a week, doesn't actually mean the value reflects the value that somebody would pay for them. So is this indeed shielding Tiger Global from showing huge losses, or is it essentially just saying, you know, we're marking these quarterly, so we're not actually showing the volatility and the fluctuations?
Well, it's a little bit of both. I mean, on the one hand, Tiger Global, because they've lost a lot of money in their public stock funds, most of their money now is in private companies. And that sort of shields the business because people are locked up in those investments, in those funds for 7, 8, 9, 10 years. So people couldn't pull their money even if they wanted to.
They couldn't. You're right.
But on the other hand, there's this idea that as you said, they only mark those companies on a quarterly basis. And because they hold them for a long time, and because sometimes you don't change the valuation unless there's another round of fundraising, the valuations don't change as quickly as they do in the stock market.
All right, we're going to have to leave it there. Big thank you to Bloomberg's Catherine Burton for that. You know, one thing I'm thinking about, guys, as we get to 2023, and check out the Bloomberg exclusive on the terminal, by the way, talking all about Tiger Global and the shift to VC. One thing I've been thinking about is if we do indeed start to see that, what does it mean for large pensions and institutional investors who have certain allocations that they have to give to different asset classes? If we start to see valuation shift in that sense, do we start to see, you know, an over-reliance on private equity or getting out of public equities?
Some of these big pension managers that, because obviously we know they had to shift into that because you weren't getting yield in the traditional spaces for so many years. You know, what they're telling me is that basically they don't need to. I mean, they are in this for the long haul. That was the original intent. Right. They anticipated that there would probably be drops, at least on a year-to-date basis for some of these investments, but over the long haul, they think it'll work out. The other question, though, too, is where do you go, right? You have to find a home for that money. Right. And remember, it wasn't just the bond market, you weren't getting the yield, but you didn't even have the scale to make those investments, at least not the way they needed to.
What's also noted in this story is that this is a firm that has, you know, consistently been focused on tech and consumer. Yeah. Those are areas that are out of favor. You know, how do you pivot away from that? And, you know, if that's what your mission is, it's really difficult to find those returns. All right, coming up, folks, hard to believe, the last hour of trading in 2022. We're going to talk about the markets. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. and digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Let's go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Jay Powell warned you, but some folks, well, you just didn't want to listen. The era of cheap money coming to an end in 2022, and well, the era of heavy gains, at least for now, appears to be gone. An S&P 500 that started the year at a record high looks like it's going to close it out somewhere around 3,800, guys. That's about 20% below where we started. Romain Bostic here alongside Tim Stenovic and Carol Massar, counting you down to the closing bell on this final day of the final year.
It's not been an easy trek this year, that's for sure. All over the place, ups and downs, and often in one day we've seen like incredible amounts of volatility.
The volatility has been insane this year, but it was interesting because I wanted to kind of see, okay, was this the most volatile year ever? Surprisingly, it wasn't. I looked at it on a points basis, and you could sort of make an argument. I think we had something like a swing of like 1,300 points or so from peak to trough on a closing basis here. But then when you sort of smooth that out, because obviously you have to account for the size of the S&P growing, and you smooth that out historically, not really.
Not that
I mean, it was actually worse in 2020. It was worse, I think, in 2014, 2012, 2008, even on a percentage basis here.
So high to lows in terms of a given day, or just in general?
Just in general.
Okay.
But the general idea here is that while there was a lot of volatility, this wasn't exactly unusual. But this also gets into the perception issue, because remember, heading into 2020 and 2021, remember, volatility didn't exist, right?
No, it didn't exist, right? It was kind of all.
I mean, it existed, but it really wasn't a thing.
I don't know.
I mean, you could have just shorted vol for 3 years and made a fortune.
Maybe also for the perception issue. I remember 2020. Wasn't that long ago. And maybe it's because when we ended the year higher significantly that year. So
I just wonder, are we too complacent? I don't know. How do we read it? All right, let's see what Bloomberg's Abigail Doolittle has to say. She's been watching a lot of different market indicators. We're going to start where we talked about a lot this week, the Santa Claus rally, which really didn't happen. Let's be fair, even with the rally yesterday. All right, Abigail, so let's start there.
Yeah, well, it's sort of an on and off again type of an event. Yesterday
yesterday, I should say, up about 0.7%. So Santa was in town, and then today, not so much.
Santa had dinner, saw a show, and got the heck out of here.
Yeah, got the heck out of here. Although we do have 2 days.
2 more days, thank you.
Yes,
I know. She doesn't believe in Santa Claus, but
I so do.
Okay, I thought that Carol would be a Santa Claus believer.
Thank you.
But you know what's interesting is the Bulls can't put 2 days together. You know, you had a big up day yesterday, and it kind of is just reminiscent of this whole year. And Romaine, I loved everything that you were saying about the markets this year, and especially this backup in yields. Like traders not believing Jay Powell. Bond traders have gotten caught offsides time after time. And earlier I misspoke in terms of the amount of movement up for yields. I said it was above 2.5%. It's above 3.5%. I mean, the 2-year yield and the 10-year yield both rising on the year by 3.5%. The worst year for 10-year notes since 1999.
And this is, and I mean, I was looking at just the returns. I think the Bloomberg index, the main index that tracks it on a global basis, what is it, down like 20%? And even on a hedge basis, it's like 12 or 13%.
Yes.
But the thing about that, though, is so many people were focused on the big sell-off in equities this year. And the fact that this bull market came to an end after what, 40 years, more or less?
Pretty tremendous.
And the idea that most people don't think we're heading back into a bull market anytime soon.
You know, that's an excellent point, Romaine. It's so interesting because this year, everybody, myself included, I've been so focused on this stock sell-off and this volatility that we've seen for stocks, not focusing on exactly that. That's a great point. I mean, that trend on the 10-year yield held like a glove for 40 years, and it's been broken. And we've talked about it in terms of the Fed, but we haven't talked about it in terms of that coming to an end. And what's so interesting to me is the 10-year note having its worst year since 1999. What was 1999? The height of the tech bubble. That meant nobody wanted into bonds. So this year we have a similar kind of sell-off, but it has everything to do with the Fed.
Okay, last question, Abigail, about calendars and the actual importance of a quarter ending, a year ending, and then a new beginning in 23 for the stock market and for the bond market. From a technical perspective and from a fundamental perspective, this stuff actually matters.
Well, that's interesting. Yes, I would say some of it's psychological. From a fundamental standpoint, I would say some of it's more psychological than anything, although you do have tax law selling and that kind of thing that could take advantage. But from a technical perspective, it does matter because if you look at charts on a monthly, quarterly, or yearly basis, that's where some of the wonky, in-depth technicals really can take a different view. Different moving averages come into play. I will say the longer-term charts are constructive. The other day we were talking about with the S&P 500 holding some of its long-term key moving averages. That could be a positive. I think next year, right now, the takeaway of most of the charts, most of the fundamentals, it really is some sort of wide sideways range right now. That's maybe one potential message. Volatility, the way we started out.
More volatility ahead.
I always feel like, though, it's like, this can't happen again. And then we get into another year where it's a lot of unusual trades.
Really appreciate your time, Abigail Doolittle. Thank you so much. Well, earlier this month, Bloomberg News came out with a story noting that muni bond sales this year down around 19% at about $351 billion. That's according to data compiled by Bloomberg. So with a look at the muni market and credit market overall, we welcome right now Yaffa Ratner, Senior Managing Director and Head of Municipal Credit at Hilltop Securities, joining us via Zoom. 2022, not a great year for at least sales of munis. Yaffa, what does 2023 have in store?
Well, we're super excited about 2023 as the fixed income markets are finally yielding some interesting returns on a tax-exempt basis. However, we also similarly encourage significant vigilance as you evaluate which potential securities you might want to be constructive on. There are going to be some minefields out there as we head into 2023.
Well, let's talk about that here, because there did seem to be a little bit more enthusiasm in the muni space, particularly, I think, because expectations in 2020 and 2021 was so dour for a lot of these cities and states. And then, of course, we saw that the pandemic actually helped a lot of these cities and states, if not get back into the black, and at least certainly right-size some of the issues here. What pulls people back into this market? What sort of whets investors' appetite?
So I do think that if we're heading into some sort of economic or any type of recessionary pressures, I do believe that we should be constructive on essential purpose revenue bonds, particularly water, sewer, power, where in excess of 90% of the transactions are rated A or higher. And if people are looking for more yieldy opportunities, we would definitely be looking at charter schools where about 2/3 of the ratings would be BBB or BB, and frankly, about 1/3 of the market is not rated.
What about
And
new
I do
issues?
think that
Forgive me.
Oh, go ahead. I'm
No,
sorry.
no, no. Please continue.
No, I was simply going to say that the rates and the risk-adjusted rates right now are actually attractive for the first time in a number of years.
What are you anticipating in terms of new issuance? Can you get kind of a good feel in terms of what kind of market environment it will be for that?
Yeah, that's a great question. And frankly, we know that new issue market volume last year was down close to 20%. And we've seen estimates for 2023 ranging from a similar number, about 350 billion, to all the way up to 500 billion. My instinct tells me it's probably be closer to 2022 levels, maybe slightly higher. We'll see some new money opportunities. We've learned how to structure high yield deals in the current environment, as well as there will be more refunding opportunities. So my guess is somewhere slightly higher than 2022.
Yeah, but one of the interesting things I think coming off of the pandemic was that we realized we could kind of almost work, for many of us, work anywhere in the country. You had a lot of movement. For the first time, you had a population that was stuck. You didn't see a lot of movement or mobility for decades, finally moving around. How does that impact, you think, potentially where we see that new issuance or where the muni market looks more interesting, the returns better because of some of those pandemic movements?
Yeah, there's no doubt that we've seen movements, particularly to the southeast, where people are, quote unquote, moving to Florida 30, 40 years earlier than had been originally anticipated. It's certainly a tax positive climate. And what happens as a result when you're seeing demographic shifts is you're seeing the need for more roads, more bridges, more schools, hospitals, and public service type buildings. So definitely we're going to expect to see additional volume in the states that are absorbing the demographic shift.
Yeah, if I'm wondering about opportunities, you talked about opportunities from the perspective of what we'll see next year, right? Talking about infrastructure projects, utilities. What are areas of concern, areas to avoid?
So I'm particularly sensitive about senior living, healthcare, and project finance. Let me unwrap a little bit the senior living issue. Frankly, senior living occupancy, which is your primary determinant of revenue, has not restored fully back to pre-COVID levels. At the same time, senior living operators are dealing with inflationary increases, particularly as it relates to labor and food, which together account for more than 2/3 of their operating budget.
I guess I'm just surprised to hear that from a demographics perspective, because we hear so much about, older generations aging into these senior living homes. So it's surprising for me to hear that.
10,000 baby boomers are aging into 65 and older per day at this point. Completely agree with you. It's the funding paradigm that needs a little fixing. Right now, your revenues are not growing at the same rate that your expenditures are growing, given pressures on labor and food. And as a result, it's creating a whole lot of headline noise. In fact, half of the defaults in the muni market this year were in the retirement sector.
All right, we're going to leave it on that note. Yaffa, thank you so much. Yaffa Ratner, Senior Managing Director and Head of Municipal Credit at Hilltop Securities, joining us on this last trading day of the year. I mean, what goes with the economy, right? I mean, I hear a lot of investors say that's where they like to park their money, in the municipal bond market. But I do wonder, if we have a problematic economy next year, what it means for these types of investments.
Yeah, but I mean, this gets to the broader question just about credit writ large. The idea that you typically, heading into these economic downturns, credit ends up being that canary in the coal mine. And then at least the people who see the glass half full right now, they look at spreads, whether you're talking about corporate credit or even what we're seeing in the safer areas, traditionally safer areas like government debt, sovereign debt, and they're just not really seeing the risk there. Now, there may be some duration risk, some term risk, but as far as any potential credit risk, and even to a certain extent interest rate risk, may not necessarily be as much as pronounced as it was here in 2022.
She made a good point, though, coming off the pandemic, right? All of these local governments, cities and towns really got some boost because of some of the aid.
Opposite of what many people thought would happen, that they'd be, running out of money as a result of people staying home. Well, now let's get you up to date on some of the news from around the world. Here's First Word with Madison Mills.
Thanks, Tim. A House panel has released 6 years of Donald Trump's tax returns. That ends a years-long battle between Democrats and the former president, who fought to keep his financial records private. The Trump returns show that he and his businesses lost millions between 2015 and 2020, and that allowed him to minimize his tax bill. And travelers from China to the UK will be required to have a negative COVID test. That new policy starting on January 5th. The move comes just after some European health officials called restrictions on those travelers from China unjustified. And in Canada, the merger court has cleared the way for the union of two of the country's biggest telecom firms. The competition tribunal ruled in favor of Rogers Communications' $14.8 billion deal. That deal was with Shaw Communications. The ruling said the federal antitrust commissioner failed to prove that this merger would cause significant harm to competition. And over in Myanmar, Bloomberg has learned that deposed leader Aung San Suu Kyi has been sentenced to 7 more years in prison. This comes after she was convicted of corruption. It was the final round of verdicts against her since the military ousted her democratically elected government in a 2021 coup. Suu Kyi's total prison term is now 33 years. Global news 24 hours a day and on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Madison Mills. This is Bloomberg. Carol?
All right, Maddie, thank you so much. Guys, I got a question for you. What asset class are you watching most or thinking about for 2023? Romain?
I'm still focused, I think, on commodities because this was sort of, I think, kind of front ran the bond market, and I think to a certain extent it front ran the FX market in 2022. And I think a lot of traders in that space really saw what was coming. I think the flip to dollar weakness that we've seen, at least over the last couple of months here, if that does persist into 2023, I think that might end up being the tail wagging the dog, not necessarily the bond market.
I'm looking at mega cap tech. It carried us for the last decade. Has the regime shifted?
I'm thinking about crypto because you know what? Coming up, Sam Bankman-Fried tweeting for the first time since his arrest as authorities seize billions in FTX assets. We're going to talk about that. That's coming up. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and radio.
Of course, one of the big stories of the year has been, well, the collapse in crypto and certainly the collapse of a lot of the big players in that space. An eye on Sam Bankman-Fried, who for some reason has resurfaced on Twitter. I'm not sure if that's in the advice of his lawyers or not. And of course, a lot of talk now about what went down in the Bahamas, learning that the Bahamian Securities Commission did reveal that it had taken control of about $3.5 billion worth of digital assets at FTX. This is after the bankruptcy filing back in November. Hannah Miller has been covering all this for us, and she joins us right now. And Hannah, I do want to start off first with what we learned about the Bahamian authorities taking control of these assets. First of all, have we confirmed that? And two, are these assets in traditional fiat currency, or are they still in digital currency somewhere?
Yeah, so we have confirmed that the Bahamas has seized $3.5 billion worth of assets. Yeah, I think it's most likely a mix of digital assets and traditional money. But yeah, this has been done as a precaution. They cited the $372 million hack that rocked FTX just hours after the company filed for bankruptcy on November 11th. So yeah, this is kind of a precautionary measure to further protect FTX's funds.
Okay, so when it comes to creditors and when it comes to customers, do we know how much more money is needed in order to at least start to repay some of these creditors, some people who are owed money?
Yeah, so the numbers are still a little bit up in the air. We don't know the full details about who top creditors are, how much they're owed. So that's still being figured out. But yeah, no, we've actually also seen some recent movements with funds belonging to Alameda Research. So again, there's a lot of uncertainty here.
Hannah, you know what I found interesting too about this story, that their seizure, the Bahamian authorities' seizure of that $3.5 billion was done based on information provided by Sam Bankman-Fried. So I'd love to be a fly on the wall in terms of the conversations that are going on between authorities, whether it's in the Bahamas or in the United States, with SBF.
Yeah, you and me both. Yeah, I think it's going to be interesting to see what happens here. It seems like there are new developments every day with this case, and there's new information that we're learning every hour, it seems.
Is it safe to say, though, they need his cooperation to understand certainly the connectivity between all of these organizations so that they can hopefully, seize as many assets as possible?
So we already know that authorities are collaborating with Alameda, the former Alameda CEO Caroline Ellison, and former FTX CTO Gary Wang. So they are providing strong evidence here, and perhaps that is enough for regulators to make their case.
And we should point out here, just keeping track of the news flow regarding this story here, the Wall Street Journal reporting that Sam Bankman-Fried is likely to plead not guilty to the 8 counts of fraud. This is at a hearing that is scheduled for next week. Again, according to sources close to the matter that the Wall Street Journal reporters have spoken to, SBF is likely to plead not guilty to those 8 counts of fraud, Hannah. Not necessarily a surprise here, though, but as we get into sort of, I guess, the nitty-gritty of these hearings in court, whether it's the actual fraud charges or some of the bankruptcy proceedings here, what more is left to learn? I mean, how much do we not know?
There's still, I think, a lot that we're going to learn down the line. What exactly happened here, where some of the money is, what exactly is the contagion here, and who's affected are all things that we're trying to learn more about. So yeah, I'm excited to keep watching developments here.
Romaine mentioned that SBF is back on Twitter as he is in the custody of his parents in Palo Alto, California. He is allowed to be using computers to a certain extent. He's not allowed to start businesses or buy things for over $1,000 in addition to other restrictions. Here's a tweet that he sent, his first one since December 12th. He says, "None of these are me. I'm not and couldn't be moving any of those funds. I don't have access to them anymore." This is a story in Cointelegraph that he is tweeting out that says Alameda wallets become active days after SBF bail. Community moles, foul play. Hannah, you referenced this idea of money moving in Alameda. What's the concern here, and why is SBF publicly come into his own defense right now?
Yeah, so it's about $1.7 million worth of funds.
1.7 million?
1.7 million.
That's this this is a guy who's been who's has a $250 million bail. Why does anyone care about $1.7 million?
Well, the fact is that there's still a lot of questions on who exactly this money belongs to and whether it should be frozen as the bankruptcy proceedings move forward. So the fact that there's $1.7 million mysteriously moving out of these wallets is really strange. And, there is a question here of who's doing this and, whether it's an inside job or a hack. There's a lot unknown here. And it seems like SBF has wanted to deny complete involvement with any of these recent transactions.
Hannah, one of the things I love about the business world, the financial markets world, that even with downfalls, go back to the tech fallout in 1999 and 2000, we now, the internet just consumes our world, right? And online, whatever, consumes our world. I do wonder how you guys think about, or how you are thinking about, having seen kind of the booms and bust already of crypto over the last few years, how you think about it for 2023. Is it the more traditional finance now comes in and says, "Hey kids, we've got this," or how do you think about it?
Yeah, so I think what's happened with crypto is, yes, there have been these previous bull and bear markets. There is this cycle, but any misstep now within the digital asset industry is just going to be on a much larger scale. Crypto is more mainstream now. More people know what Bitcoin actually is, and whether that'll disrupt future market cycles and kind of break previous patterns for crypto remains to be seen. So that's something we're watching in 2023.
Okay, what about other things that we're watching in 2023? And I kind of alluded to this earlier in the week, Hannah, about this year to me being a fundamental shift. I mean, if we were talking a year ago and some change, we'd be talking about people leaving TradFi and going to work in DeFi, going to work in crypto. We're actually starting to see anecdotal evidence of some of those people going and starting to work back in TradFi again, traditional finance. What does 2023 have in store, at least for the continued adoption or lack thereof of crypto, given that 2022 was, well, such a terrible year?
Well, I think one thing we need to watch next year is the movement of regulators into the space. Their further encroachment could spook people, spook investors, spook people working in the industry, and kind of push them back into traditional finance, which they may see as a safer haven here. So it'll be interesting to see what happens. But yes, like movements among institutional investors is something we're watching. Even just crypto leaders, whether they're sticking with the industry, is also something we're keeping an eye on.
Is there any sense here, Hannah, that the narrative that we get out of the crypto faithful will be any different? Because we sort of swung from store of value to use case to, God knows what. But I feel like that those have already been exhausted. So if you're already knee deep in this, sure, you stick with it. But how do you sort of convert? How do you sort of woo those folks who are, I guess, looking for a reason as to why this thing even exists?
Yeah, so when I talk to really staunch advocates of the industry, decentralized finance comes up again and again. We've seen, people push this as a better alternative to traditional finance, and that DeFi can actually help prevent things like what happened with FTX, that centralized entities are, the root of evil, and that it's actually decentralized entities that are the answer. So it'll be interesting to see whether, the focus on DeFi becomes even stronger as we move into 2023.
Hey, just real quickly, before we wrap up, is there the next JP Morgan of crypto that you're keeping an eye on and that we all should be keeping an eye on?
Maybe nobody wants to be called that anymore, right?
Is there someone out there?
The next JP Morgan of crypto.
Well,
I don't know.
Who's the guy?
I sure hope Jamie Dimon doesn't listen to this show.
No, but who's the guiding light
and I know he
that
doesn't.
is the next kind of voice we trust in this space?
They called it SBF.
Yeah, I don't know if people want that label anytime soon, if people see it as kind of a cursed label. So yeah, it'll be interesting to see if anyone tries to fill SBF's shoes in that, and if they want to take on that title.
Well, the context for that, of course, is earlier in the year with the downfall of Three Arrows Capital, when you saw all these DeFi companies kind of filing for bankruptcy. He would go in and rescue them. He would go in and buy them, and then he got the label right, the JP Morgan crypto.
But you know what I'm saying. Like,
I never called him that.
Turn to, besides our Matt Levine on crypto.
Goodbye, Hannah.
Happy New Year.
Happy New Year. We'll talk to you again, and I guess when the next JP Morgan of crypto
shows up. You know what I mean, though. But like, whenever there's a new industry, right, somebody becomes kind of a spokesperson for it, and I do wonder.
Yeah, they need a spokesperson. He was it for a while. I guess CZ is trying to sort of put himself in that position now. But at the end of the day, it's all about not so much who puts themselves out there, but who people trust. And of course, we learned they put trust in SBF, and of course, that trust, at least for now, appears to not have been wise. There's a lot more to talk about. Not having to do with crypto. We're going to talk about the housing market because we talk about the lagged effect of rate hikes. No lagged effect there. The housing market decimated. Jason Kern over at Cortland going to be here to talk about opportunities. This is Bloomberg.
big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Markets. To close the final trading day of the year here, and we're going to go out with a little bit of a whimper, at least on a daily basis. We are off the lows of the day with the S&P 500 down about 0.8%. That's pretty much the story across all the major indices here, but the bigger story here is on a year-to-date basis, basically down about 20%. We've been in a bear market since the middle of the year, June 13th to be exact. A key date here because, of course, that big Fed meeting was June 15th when they raised rates by 75 basis points, raised them for 75 basis points 3 more times, and then kept going. And Jay Powell has told us he plans to keep going into 2023. The question is, has the market finally adjusted valuations to be a little bit more in line with those expectations, guys?
It's a good question. Isn't it amazing when you think about it? It was just June when the Fed started to really be so aggressive there and change in terms of its policy, because it feels like it felt like it all year if I look back at this point.
Well, and just to be fair, I mean, they did raise 25 at that in February, then 50. But then when they got that 75, I think that's when the market finally realized, oh, this guy's serious.
Yeah, he's looking to do something. Well, what really got serious was...
Have you ever seen Jay Powell laugh? Does he have a sense of humor?
I'm sure everybody has a sense of humor.
I don't know. There's some people I work with around here. I don't think so.
All right, moving right along. Many people are not laughing about the housing market right now. Those mortgage rates, I don't know if you noticed, but in the U.S. rose for the first time since mid-November. We've seen them kind of pulling off some of those highs, but nonetheless, we've seen a slowdown, difficult for buyers and both sellers when it comes to housing. So we thought, as we get ready to flip into a new year, let's check in on the housing market. We've got a good guest to do that. Jason Kern, he is the president of the investment management over at Cortland. He joins us from Atlanta. Jason, welcome to the show. So the housing market, let's just go for it. What's 2023 going to hold for those in the housing industry and for buyers and sellers?
Yeah, thank you very much, and Happy New Year to you all. Well, you know, our business here at Cortland is in the multifamily housing sector, so we own, manage, develop multifamily apartment buildings, basically. So the single-family housing market is a bit of an adjunct and almost a competitor in some ways, in the sense that about 20% of our residents in our apartments leave our units in order to make a first-time home purchase. And so, ironically, even though the rising interest rate environment that you all were just talking about, 350 basis points of Fed funds raises over the last 6 months, that has certainly negatively impacted our business. But the slight silver lining, actually, for us is that it has increased the expensive inaffordability of single-family housing. So in a weird sort of way, it keeps a lot of our tenants in place, just because unfortunately it's harder for them to buy that first-time home when their mortgages have gone from 3% to 7% almost overnight.
Jason, can you talk a little bit more about that? Because I thought one of the more interesting things about some of the housing data that we got this year, of course, we saw the big drop-off in housing starts for single-family homes and permits as well. Of course, the trend line, as I'm sure you know, for multifamily has been a little bit more on an upward trajectory, at least in the second half of the year here. And I am curious, what's driving that? Is it short-term issues driving that, or are there longer-term structural issues driving that?
Yeah, it's really, I mean, there's a long-term, very beneficial supply-demand dynamic in the multifamily and the single-family housing area. As an owner, as a landlord like Cortland is, there is a fundamental undersupply to this day, as we speak, of housing across single and multifamily. Our research sort of shows that we're probably 1.5 million homes short of the demand that's out there. There's others that would prognosticate that it's more like 3 or 4 million, but that puts you in a pretty positive place in terms of demand for your housing units or homes. Now, that gap can be shrunk by a lot of new supply. As you just talked about, the home builders building a lot of single-family homes, developers like ourselves and our competitors building apartment units. And certainly there was a lot of development going on, which is really kind of an appropriate response to all that demand for housing out there. The current interest rate environment impacts obviously all aspects of the U.S. and the world economy, but one place it does impact is that development activity. And we have seen new development starts in our space drop off precipitously since interest rates have started to go up. Typical
help us quantify that.
Is depending on debt finance to get those projects.
Well, Jason, help us quantify that just for your business alone. I mean, how much does it cost you to develop a project that a few years ago you could have developed for less? I mean, how much more are you having to pay as a result of higher interest rates? And at what point does it become not worth it anymore, even if there is the supply and demand issue that you talked about with between 1.5 and 4 million housing units being short?
Yeah, and it's going to very much depend by market, obviously, as always. But I mean, generally speaking, the SOFR rate, which is our base rate that we use for floating rate debt, has gone up at least 400 basis points. Spreads have gapped out 50 to 100 basis points on top of that. So you're talking about 500 basis points of extra interest costs. Also, the banks at the moment are very stingy in terms of lending, particularly on higher risk development lending. And so the sort of access to that debt and the level of leverage that you can get on a project has been impeded. And so it just makes it much more difficult. I mean, our business is a spread yield business. So, we are assuming a certain amount of rent income that we can earn on an asset after we build it or when we own it. And when your cost of debt skyrockets like it has, it just makes those margins shrink and sometimes disappear. It makes a lot of development projects simply untenable from a financial.
Well, let's go there. Let's drill down into your business. So are you guys planning to build new units? Talk to us about the environment for that. How do you finance it? Are banks willing to lend the money? Is it easy to come by? Give us an idea.
Yeah, it's become more challenging, and we're in a bit of a hold right now. We were incredibly busy, as you might imagine, for the 18 months leading up to June of this year. I guess I can still say that in the last couple of days here of 2022. So we did probably $7 billion of new apartment acquisitions during that 18-month period and have done little to nothing in the last 6 months, not surprisingly. Not starting new developments at the moment, really taking a wait-and-see attitude. It's part of what the overall industry is doing. There's a wide bid-ask spread, whether you're developing or whether you're buying and selling apartments, to see what buyers are willing to pay, given higher interest rates, given kind of a lack of price discovery. Just not a lot of transactions are happening. That tends to create a little bit of rigor mortis in our industry. And people that are selling aren't yet capitulating in terms of how much they're willing to cut their prices. So I expect it to be quite slow, going back to your original question, for the first half of 2023. But like all financial markets, uncertainty is the big bugaboo that is keeping people on the sidelines. I expect that by the middle of 2023, we're going to see some clarity, at least in terms of what Jay Powell and the Fed are doing. Our estimates is that we might actually start seeing rate cuts in the middle of the year. And once you have that clarity, you're going to have a lot of capital that's currently sitting on the sideline come back into the market. I think it could be a very busy and very interesting second half.
As that potential capital, though, also sort of adjusted to the potential reality that even if you do get a Fed pivot, a cut, which I think, at least based on market pricing, is still a bit of a long shot. But if you do get it, it's not like they're going to take it back down to the zero bound where we were at the start of the year. Can they live with 5%, 4%, or even 3% on a Fed funds rate and whatever that feeds into with regards to the cost of capital?
Yeah, you can. And, the price adjustment that we're currently experiencing will increase the going-in yields and returns on assets on an unlevered basis. So then if you add on leverage that is more expensive and maybe to lower LTV, those two things can balance out, and especially in multifamily, we have a couple of great advantages. Number one, the supply-demand dynamic I talked about. Number two, we were able to do a lot of our borrowing from the government agencies, Freddie Mac and Fannie Mae, and they have some very good programs that are very helpful for accessing more attractive finance in the multifamily sector specifically. And thirdly is just the fact that it is really sort of one of the bellwethers of the real estate industry. Investor capital over the last few years has gradually and now dramatically been going from office product, retail product to both multifamily and industrial. So that's, I think, going to buoy the market and create transaction volume that will actually, I think, surprise a lot of people second half of next year.
Jason, what can you tell us about the rents that are being paid to your firm right now? Are you seeing delinquencies? Are you seeing them being paid on time? Is anything shifted over the last few months as consumers' cash cushion has gotten smaller?
Yeah, we haven't really experienced it. Even during COVID, we didn't experience significant delinquencies. Our occupancy stayed relatively stable. I think that's partly reflective of the fact that we're in some of the stronger markets in the U.S. We're very Sun Belt focused, where there's a lot of in-migration, a lot of job growth, a lot of wage growth. And our apartments tend to be, they're not luxury apartments. Our average rents are somewhere around $1,800 per month. Our average resident is paying about 20% of their income in rent, so quite sustainable from that perspective. So that gives you an ability to increase rents, which we certainly did, like all of our competitors, when rents were rising dramatically. Those rent increases, as we all know, have decelerated dramatically. Still in positive territory. We're still rolling over rents at 7, 8, 9, 10% higher than what we charged a year ago, but really not seeing a lot of delinquencies. And again, I think that's down to the fact that our communities have good credit quality, our rents are attainable, affordable, and our residents are able to sustain, and then, in a lot of cases, their income has actually increased as well as inflation has been a big part of the picture.
Hey, Jason, we talked earlier about the adult living communities that are out there in the context of the municipal bond market or the municipal market, I believe, right? That's what we did. Yeah, just a reminder. Give us an idea of your mix of your business and what you're seeing in terms of demand there. Yeah, go ahead.
Yeah, we're not in the active adult business anymore. So our properties are straight traditional, no age restriction whatsoever. So couldn't comment.
Oh, okay. Forgive me. I think it was on your website. That's why I was a little confused.
Yeah, I'm seeing it on the website too.
Return on investments. Give us an idea of that in terms of what eats away at ROI for your investors specifically. Is it labor costs? Is it materials? What is it specifically? Is it the higher rate environment overall?
Yeah, I would say inflation is not as big an impact on our business as interest rates, which is hugely impactful. Inflation really hits us in terms of the cost of materials when we're developing or renovating assets. It obviously hits our labor costs a bit, and it can impact us if, the sort of disposable income of our residents starts to get chipped away by massive inflation. Again, I think wages have kept pretty good pace with those across our portfolio. But what I would say is that multifamily is actually quite unique in the sense that a lot of the returns that we generate for our investors don't rely on us kind of sitting around waiting for the capital markets to increase pricing. We can add a ton of value by renovating units, by going in and, renovating, putting in new appliances, swapping out counters, cabinets, taking out flooring, that sort of thing. So we can, if we're smart about it, we can spend CapEx that has a really good return on investment. And even on the operating side, multifamily is operationally intensive by its nature, and we pride ourselves on when we buy a new asset, we go in there, we're branding it Cortland, we're putting our team in place, putting all of our technologies, all of our service models in place so that we can hopefully generate higher occupancy, premium rents just by providing a better service, closer to hospitality than sort of traditional apartment living one might envision. Well, so those are all good ROI endeavors.
Jason, we're going to have to leave it there. Thank you so much for joining us. That's Jason Kern from Cortland. Really appreciate it. I thought it was interesting what he said at the top of the interview, guys, that, the idea of houses actually getting more expensive because, or more unaffordable because of higher interest rates leaves people in his multifamily units for longer. And it just makes me think that we're in this stalemate because if you live in a house and you have a 30-year fixed rate mortgage that's what, below 3% or below 3.5%.
You're not moving.
You're not moving. So what does that mean? That means that the supply issue is going to stay where it is and demand is going to continue to rise. It's a stalemate.
That's right.
It's not good.
I think, though, this is where we have to kind of give some perspective. We talk about this. Everybody talks about what mortgage rates were back in the 1970s. I mean, it's still, I think it's a life choice. And it certainly depends on whether or not you can afford a higher mortgage. And maybe if not, then you stay in these multifamily or you stay in rental. We saw rentals go up in a big way because people couldn't afford homes. So we shall see. We shall see in terms of what happens.
You guys want to talk ARC?
ARC. What are they doing? Is that sinking?
Down again.
Yeah.
For another year. Yeah. 2 years in a row.
Well, these are the moonshots, right? I mean, we talk about Cathie Wood and this empire that she built, and I don't think she ever came into this, at least not publicly, and said this is all about short-term gains. Yeah. She said she was making these big moonshots, and this is what happens. The same thing when you look at venture capital, same thing when you look at private equity. These are long-term bets, and you get down years like this. I'm not defending her. I'm just saying, Tim.
All right.
We'll be back in a moment. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
All right, we talk about the worst performing stocks on a year-to-date basis. Tesla, of course, in that group, one of the bottom 5 performers here in the S&P on this year, of course, coming off 2 straight years where it's one of the best performers, including that 700% rally that we saw back in 2020. Dan Ives, who covers this company as an analyst over at Wedbush, he's still bullish on the stock, despite the 69% drop that we've seen so far this year. He spoke with us right here on Bloomberg Television a little bit earlier as to why.
Look, it's one of the most transformational, if not the most transformational companies of the last 20, 30 years. But look, they're held to a higher standard from a multiple perspective. They get treated, and I believe they should, as a disruptive technology, not an auto player. And that's why what you've seen here, I think 70% of it is actually non-fundamental. It's Musk, Twitter driven. And that's why any sort of course correction in 2023 is what investors are really craving for.
Yeah, the Peter Drucker quote I thought was good. The heroes of the boom are the villains of the bust. I've always thought of it, though, in opposite terms, in that you want to pick the worst performers to look at, some real upside for the future. Do you see it that way with Tesla?
Look, the hearts and lungs of Tesla is Musk. Musk is Tesla. Tesla, is Elon Musk. And I think right now, clearly they're going to have some softening like you're seeing across the board in EVs going 2023. But ultimately, he gets a CEO in of Twitter. He actually stops selling stock and actually does it. And it's not boy that cried wolf. and they set what I view as sort of cautious expectations, this is a stock that could rip higher. And I think that's ultimately it, is that Musk has gone from a superhero on Wall Street to a villain, and this is really a moment of truth for him to sort of navigate through the storm.
But he's been a villain before. Abigail was pointing out to me the other day that there was a time when he, I guess, pretended he was going to take over Tesla for $428. The SEC, he got in deep trouble with them, and he kept egging them on. Nonetheless, he came back, and people seem to forgive him for that. Is this time worse? I mean, has he really gone off the rails here?
Look, I think for someone that's viewed as a modern-day Albert Einstein, Thomas Edison, it's more of a Howard Hughes type moment, right? And I think the question now is, you know, does he start to focus back more on Tesla away from Twitter? Because that's really been it. It's a brand issue. It's been a black eye for Musk, a black eye for Tesla. But it goes back to investors. They want, this is a name they want to own as a transformational company. They just can't keep having Musk. Because every time he tweets something, the controversy, it's created ultimately a black cloud for Tesla. And that's why I think this is different, because ultimately when you're at the perch, when you're at $1 trillion market cap, it's a lot different than being at 50 billion.
Yeah, his tweets are more, I think, Edison than Einstein. What stock, and because you're such a well-known tech bull, you cover the whole universe, which of these high flyers that has come down so much do you like best? I mean, when you look at across, Apple, for example, came down to the lowest level that it's been since, I think, the summer of 2021.
Yeah, I mean, if there's one name, I mean, our top pick, it's Apple, because I believe it's not a demand story, it's really supply issues in China. On some of the parts, I still think there's a stock that could be a $200 stock. And ultimately, it's fundamentals continue to be rock solid, or what I believe. But I think right now, technicals and other, in tech, the New York City cab driver right now is bearish on tech going in 2023. Apple, in my opinion, is the best way to play. And then cloud, Microsoft, what I view as Redmond, that's still a rock of Gibraltar name despite what the stock's telling you.
And that, of course, was Dan Ives of Wedbush with our own Matt Miller earlier. Well, it was, we know, a dismal year for Tesla. It was also a dismal year for, certainly, Cathie Wood. She has been a longtime investor and supporter of both Tesla and Elon Musk, excuse me. If you look at ARK Investments, worst year on record. 2023 doesn't look so good as well. Bloomberg's Emily Graffeo wrote about the year for ARK. She joins us now with a little bit of a look forward. Emily, it was a tough year, another tough year for ARK Invest and for ARK overall and Cathie Wood. Take a look year back and a look forward, because it sounds like it could potentially continue.
Right, Carol. Well, it's no surprise that the higher interest rate environment hurt ARK and Cathie Wood this year. Her fund is filled with those highly speculative technology stocks that don't like higher rates. But when we look at the earnings outlook for some of the top holdings in ARKK, the ARK Innovation ETF, her flagship fund, analysts have actually been cutting their forecast for these stocks since the beginning of December. They've trimmed their estimates for Zoom's earnings. Zoom is the top stock, but also Tesla, Roku, Shopify, and Teladoc. So some of the largest weightings in this fund, they don't look like they're going to be able to post great earnings next year. And we know that earnings really drive stock prices. So it might be another tough year for Cathie Wood.
What is funny is a lot of the companies that she has in the ARK Innovation ETF don't actually have any earnings yet. These are, as Romaine described them a little earlier, moonshot projects. Is there a bull case here, though, Emily, apart from, of course, 2020 redux, where the government doles out trillions of dollars and then drops interest rates to zero? What's the bull case here?
Well, the bull case for ARK is that there are still a lot of investors who seem to want a little slice of exposure, the ETF investors, to the theme of disruptive innovation. And so that has really created inflows throughout all of 2022. Even as the fund has continued to tumble, it's still been able to pull in positive inflows. We're looking at about $1.3 billion in net inflows for ARKK for 2022. So it might not be able to lift the fund into positive territory. Most of the investors that have started investing in the fund in the last 5 years are still sitting at a loss. But at least for ARK and for the ETF, there is still some investor support there to maybe allocate just a little bit of their portfolio to this super speculative part of the market.
And we've seen the net inflows, and we should point out there's been net inflows into the broader market as well this year, despite the downdraft, the pretty impressive ones to be sure. One issue that I think has been raised with regards to ARK and that whole empire was that when this first became popular, there's this family of ETFs, there really wasn't a whole lot of other places where you can get a sort of a basket of these quote-unquote moonshots, if you will. And the idea was that if you wanted to sort of ride this wave, then it was with Cathie Wood and her funds. But there have been a lot of other competitors who've come out to try to replicate what she has done, and as well as other vehicles out there that are either single stock trades or maybe not quite the broad basket that also offer investors a way to sort of play that. How much does that become a factor as to whether we see a rebound in ARK in and of itself?
You make a really good point. AllianceBernstein, they were one of the firms this year that launched a disruptive innovation fund. And there's a lot of active managers continuing to move into the ETF space. So I don't think we've seen the end of new fund launches of people trying to mimic that Cathie Wood style. I will say she really does have a pretty big fan following on Twitter. So that could provide a little bit of support for the fund itself. But if you look at the top 20 ETF issuers in the market, ARK used to be in the top 20 for total assets that the entire ETF firm holds. She fell out of the top 20 this year as other active managers have been growing more.
You know, what's kind of interesting too is that, you know, AllianceBernstein a decade ago, Cathie Wood pitched this whole idea of innovation disruption ETFs at that point. So this was her old firm doing it. I think what's interesting about Cathie Wood, and we were talking about this before we got going, and she's someone we talk about a lot here at Bloomberg. We've talked to her directly, that she does make long-term bets, and she kind of sticks to her knitting when it comes to this disruptive innovation theme. I will go back to, you know, 7 years ago when she started out, she was backing Elon Musk and Tesla. This turned out to, for a long time, be a very smart bet for her. She's going to have hits and misses, and we're seeing a couple of years that have been very, very dark and dramatic. And who knows what happens in 2023? Does Tesla have a turnaround? It's so beaten down. We saw investors come back in just as a
But that could work against her, too. I mean, it's one thing to say, okay, we're committed to this is the thing, but money managers, of course, also have to be cognizant that times change, and sometimes you have to pivot. And how many times have we had discussions, guys, over the course of, you know, years and decades that we've been covering this, where you had that one trader, or investor, I should say, who had that hot hand for a few years, and then they just kind of disappeared. I mean, this is kind of the cycle. And that's not to say that Cathie Wood is going away, but I'm just saying we kind of go through this
But there's
every
like two people who haven't been that, right? Warren Buffett and Peter Lynch. And Peter Lynch walked away.
Well, Peter Lynch. And I wouldn't put Warren Buffett in that category just because I feel like the types of investing he did was a little bit different than what Cathie is.
So 5-year time horizon.
Yeah.
If you were to go back 5 years and invest in the ARK Innovation ETF, you'd be down 15% now.
But I would also, you know, argue it's not just a one-hit wonder. I mean, it's been Tesla, it's been Moderna, it's been other things that have really started to occupy our conversation. The problem is, you know, what is the time frame for the payoff?
And this goes back, and Emily, I don't know if you're still, but we go back to this whole idea of that a lot of these companies were kind of the only games in town. Zoom isn't the only game in town. Tesla for EVs isn't the only game in town. And some of the other names that you mentioned, there's a lot more competition out there. Now, that's not to say that Cathie doesn't pivot and invest in those companies, but there are other options. Saying goodbye to Emily Griffin, who very patiently sat by as we ignored her, but we thank her. And she has a wonderful story, doing some great reporting for us. A lot more to cover here on the final trading day of the year. Romaine Bostick, Carol Master, Tim Stenovic, we're counting you down to the close. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
U.S. equities, well, posting their best quarter of the year. Unfortunately, the year going to end up being their worst going back to 2008. We get the closing bells here in New York, a little bit of a subdued nature here to the clapping and bell ringing. Fractional losses here pretty much across the board, well off the lows of the day. But of course, we look at today and we look at it from a perspective of what's been happening on a year-to-date basis here. The Dow Jones, the S&P, and the NASDAQ composite all lower here on a year-to-date basis. The outperformer was the Dow Jones, which is going to finish down about 9% for the year. The NASDAQ is down 33%, and of course, we talk about the S&P down, I think we're going to call it about 19.5%, so roughly about 20% for the S&P 500. The Russell 2000 not faring much better as well. A lot of investors really got spooked, I think, somewhere around the middle of the year, guys, when they finally realized that Jay Powell was serious.
Look at those numbers.
Yeah.
Down 33% on the NASDAQ.
And can I point out this out? 38.39 on the S&P 500. And I don't want to bang on the Wall Street strategists, but a year ago, late December, we did we do a survey periodically of all Wall Street strategists. Their year-end target for 2022, on average, in late December of last year, for this year, was 4,700.
So way off.
At that point, excuse me, I take that back. I'm sorry. It was 5,000.
Was it about 5,000?
The S&P was trading at 4,700 at that point. Of course, by the time we got to June, we started to see some of those estimates come down. I think the average then dropped to somewhere around that sort of 4,796 level. Then it came down to 4,400. And eventually, everyone found religion. And now it was pretty much, okay, this is over.
By December, they changed.
This is over. But then you look ahead to 2023. Not a whole lot of people are seeing meaningful gains.
We're not seeing 5,000 on many of those.
You're not seeing that at all. I think right now the average price target is for a smidge above 4,000.
Can I just tell you that number one gainer in both the NASDAQ 100 and the S&P 500 for 2022 were both energy names. Occidental Petroleum up 117%, Constellation Energy up 105%. Bottom of the pack, Rivian in the NASDAQ 100 down 82%, and Generac Holdings down 71% for the S&P 500.
And it's interesting too. I mean, you talk about more than half the index of the S&P index lower, but I was looking at sort of why. I was trying to look at sort of valuation levels and seeing was there sort of trend you can see where why certain things did end up higher here. There really wasn't. I mean, there was a defensive nature to energy, of course, being higher and some of the healthcare stocks. But a lot of what sort of got sold and even some of the stuff that got bought really seemed much more idiosyncratic. And you wonder if that becomes a story for 2023 or if it does sort of stay in this sort of macro, all things Fed.
So you know who has to stew over this? Is our own Abigail Doolittle, because she is in and out of the markets for us always, which we greatly appreciate. So here we are, last trading day, we're done. What's at top of mind here for you?
Well, I just have to bring it up. I know it's kind of silly, but we've been talking about it all week. Santa is back in town because we do have stocks finishing off the lows.
Really hard to find Santa.
I know.
He left his wallet at the theater, came back,
and now he's interested in January.
I don't know where you're seeing him.
So over the last 5 days, we do now have stocks up about 0.5%. Now, the reason I'm bringing this up is it is sort of silly on the one hand, but predictively, it does suggest the next year is more likely, if it happens, to be an up year. I think it's something like 75% of the time. Now, when it doesn't happen, it's more likely to be a down year. Now, the big exception, obviously, is last year, where it happened, and we've had the worst year since 2008. But I would say the biggest theme this year...
I was looking at that. So, I mean, we haven't had 2 consecutive years of this magnitude. Is that the idea? I mean, we've had it, but only like, what, 3 or 4 times, right? Over
over since
the Great Depression.
Yeah.
Right. But the idea, but I was looking, so Goldman Sachs had put it out, I don't know, I think it was maybe like 3 or 4 weeks ago, so I don't know if they still stand by this, but the folks over there, and I think included like Peter Oppenheimer and Sharon Bell, they were talking about this idea here that the bear market isn't over because we didn't really hit at least those historic technical levels. We didn't really hit those historic drawdowns, which I think by their estimates are more like 35 to 39%. So the idea, at least if you go by the almanacs and stuff, there still has to be more downside.
You know, I think that it's dangerous to use any kind of must be or not be, always or never. I will say that this year, all year, has reminded me a lot of 2000 to 2003, 3 down years. That's one of those 2 time periods where we have had big annual declines. Also similar there really was never a recession. It was a liquidity bubble popping, which you could make the case here too, coming out of the pandemic.
You know,
you stumped him.
Yeah, well, I was just thinking about
we all are after this year.
Of the difference between 2000 and 2003 was, the tech bubble bursting, and the tide kind of went out there, and we saw who was exposed and who wasn't. And if we think about that right now, we're not really seeing those underlying isures, right?
Well, I don't know. I mean, the whole SBF, I would say that he's been completely exposed. Bill Huang, 2 years ago.
Yeah.
This has been out of the pandemic.
But the contagion wasn't there with these things.
Well, it's interesting that you're saying that because it's not, neither are major asset classes. So it's not like the housing or the tech bubble, because like we were talking about last year, the last time that we had treasury notes down as much as they are this year, it was 1999. And that was because there was no demand for bonds because everybody wanted to be in stocks, and you had all of that money going in that direction. I think we've been pretty fortunate in the fact that there hasn't been any contagion this year. I mean, that's a good thing. But I don't think that lessens. I mean, look,
I would argue too that there's been safeguards put in place coming off the financial crisis.
Yes, I would agree with you on that too.
Especially when it comes to the big banks and the financial community, so that it doesn't happen again.
Yes, I would agree with you on that. And in some ways, to your point, Carol, it's interesting because we were talking about all of these things that we've kind of missed all year long in terms of all the winners, the fact that the volatility, while it's felt like crazy, is not the worst ever. We've sort of haven't really been talking about the end of the 40-year bond bull market, in part because we've been so focused on these stock declines, because I think that we do have the GFC in mind, and what could that mean, or the popping of the tech bubble as well. So it's an interesting time period. I mean, I think the one thing that's really interesting to me, and we've talked about it a few times on radio all year, is housing. I mean, we have a recession in housing. Where's the contagion from that? That is curious to me. Now, of course, during the great global financial crisis, it had everything to do with the CDS and going out into all of the banks and bankrupting different entities. But at some point, you would think this is one of the biggest asset classes. I mean, for most people, their home, it's their biggest source of wealth. Where's the contagion from that?
Maybe nobody has to move because they haven't lost their jobs.
Changes the velocity potentially, right? In moving and then buying all new stuff and all of that helps
not the same
turn the economy.
Mortgage exposure that people had back in the GFC. But
yeah, I mean, I think some of it also is, to some extent, the housing market is gridlocked. So people, and in terms of back then, there was also a lot of default happening. So there was all of that turnover. Whereas now, I think people are more stuck and staying in place.
All right, we're going to run. Abigail, thank you so much. Happy New Year. Thanks for all of your smart market coverage throughout the year. We really appreciate it.
Let's bring in Alan Zafran. He is the co-CEO and founder of IEQ Capital. He joins us this afternoon from California. Alan, always good to see you. Want to bring you into this conversation about what to expect next year, because 2022, for many investors, if they were long this market, was just absolutely brutal. Where are you seeing opportunities? Where are you deploying new cash when it comes to next year?
Well, first of all, thanks, Tim and Romaine and Carol, for having me on the show. I am unfortunately in the camp that in the short term, this widely forecasted recession is slowly rolling into place, and it means you still need to have a relatively short-term cautious approach for risk assets. But as always, crisis is going to beget that opportunity, and for anyone that's got any kind of a longer-term investment horizon, you should be slowly, methodically buying into the weakness, because inevitably the economy will bottom, the Fed will pivot, people will look forward to much better growth in 2024, and we'll be off to the races again. And to relate to exactly what Abigail just said a moment ago, what we had in the back in the tech bubble or the great financial crisis, people had negative equity in their homes.
Yeah.
So they couldn't move. Now what we have this time is we have 7% mortgage rates, and we have high cost of affordability, so nobody can move. And so the effect is there's less activity around new home purchases and moves, which means there's fewer landscaping, there's less painting, less home furnishings being purchased, and that is a slow trickle-down effect into reducing new order activity. It slows down economic growth, which leads to lower profits, which leads to higher unemployment, which leads to Fed inevitably lowering rates. We're in the cycle, and the benefit is everyone's been forecasting this recession ever since the first rate hike, and so people are already positioned to a degree for the inevitability of this recession.
Right.
It's now a matter of just dealing with it as it comes.
Dealing with it as it comes, and looking for opportunities there. When you look for those opportunities, does it just become sort of look to the most beaten down sectors? You look to real estate and you find opportunity there because it's in theory at a bottom, or some of the tech stocks in theory that are at a bottom, or are there going to be structural shifts coming out of this that investors should actually be looking to that might suggest that it's going to be different industries leading the charge?
Well, I think this year taught us that being long tech only isn't a great long-term strategy, because the NASDAQ's down 33-34% instead of the Dow only down 8 or 9%. In the short run, what we're going to find is you're going to find your typical safety stocks, healthcare stocks, utility stocks, consumer staples will outperform more aggressive stocks. If you are looking for greater outsized return, ultimately, as the economy slows, as valuations drop a bit more, you would begin to tilt to more aggressive sectors, consumer discretionary, biotech, tech. Businesses that don't generate cash flow are going to be the most squeezed in a slowing economic downturn. But once it tilts, dollars will quickly flow into those more aggressive assets, and they will recover more quickly on the upswing. And of course, it's a question of how bad does the slowdown get, which is a function of how many rate hikes we get. What other exogenous effects, like how quickly can China come back into the global economy as it gets away from COVID lockdowns? There are too many variables to be highly predictive. What you can see is the rate hikes are going to slow down economic growth. There is going to be greater opportunities to buy assets as prices fall, but predicting the specificity of how far it falls is hard to do.
We're talking with Alan Zafran of IEQ Capital. Just a reminder that we just wrapped up the last trading day of 2022. S&P 500, the NASDAQ 100 posting their biggest annual decline since 2008. And we've been reminding everybody it's been the best year on record for energy names in particular. So we've seen investors, we know that, all year moving in. Alan, having said that, when you look at 2023, your highest conviction play here, is there one that you can say is going to be a sure thing, and maybe it doesn't necessarily pan out next year, but longer term? Because I do wonder, are we going to look back at this time and say, this was a great buying opportunity, at least on the equity side of things?
I think you're going to look back and realize it was a great buying opportunity as prices fall over the first 3 to 6 months of this year. And you'll look back and realize you should have been buying into it. Even in the near term, I think real estate is a great example of a durable asset class with cash flows that are inflation resistant. And I do think that the net operating income growth that selected REITs in the residential sector, in the apartment sector, in the self-storage sector, in the industrial sector, those are durable net income growth rates that will more than offset valuations that drop a bit as cap rates, meaning PE multiples, go down or cap rates go up. Ultimately, those are very durable asset classes that generate attractive levels of income.
Right.
And many REITs are trading a material discount to the current net asset values on the books of those companies.
But down
It's an
25%
example of
as a group overall.
where there's
Yeah.
So, Alan, going back to your comment earlier about, bottoming just in the first half of this next year, how are you going to know when that happens, and how do you know that the S&P 500 hasn't priced that in already?
Great questions, Tim. You really don't. What you can do is look at historical precedents like Romain cited. Average recessions, you might see the S&P 500 fall. It's at very nadir 35%. When COVID hit, the bottom was at 33%. You can try and use valuation estimates. If you think we're going to have a very, very shallow recession, there might be no earnings growth next year, in which case the market's already trading at only 17 times earnings. We're close to the bottom. If you think we're going to enter a recession of some depth and you cut earnings estimates by 10 to 15%, the S&P will only earn about $200 per share, and you could put a 16 multiple on that, and that gets you down from 3,800 to 3,200. My guidance to people is slowly, methodically, dollar cost average down in small increments of things that you have a long-term horizon to buy, and don't try to perfectly time the bottom. Technically, stocks bottom well before the economy bottoms.
Yeah.
Other than the moment the Fed actually lowers the rates, not just signals, but actually lowers the rate.
All right,
it's very
Alan.
hard to.
Alan, we need to leave it there. Alan Zaffron over at IAQ. Have a wonderful new year. We'll catch up with you in 2023, I'm sure. Still a lot more to cover here on the show, including the wild year in the FX market. The Bloomberg Dollar Spot Index closing out the quarter down 7%. This is Bloomberg. All right, well, this shaped up to be a wild year in the FX market, particularly with regards to that relentless dollar strength that we saw for basically the first 8 or 9 months of the year. That sort of peeled back pretty significantly here. And in fact, the dollar, at least as measured by the Bloomberg Dollar Spot Index, down about 7% here in the fourth quarter, still higher by about 6% here on a year-to-date basis, but a lot of questions going forward as to what 2023 holds. Vincent Signorella joining us right now, former FX trader, and now helps run our macro squawk team here at Bloomberg. Dollar weakness, that seems to be the trend right now, or at least over the last couple of months, Vince. Is that the story in 2023?
I think so. I think your previous guest at least hit a lot of highlights that are of my opinion as well. I think the recession is inevitable. The depth of it is going to be difficult to predict, of course. We've already seen the housing market react to Fed rates, employment's beginning to react. I definitely think we're going to see the rest of the economy react next year. Wage growth is not keeping pace with inflation. That needs to come back into balance. And until that does, I think the growth cycle is going to continue to go lower. I think we'll see stocks a little bit under pressure. But I don't see the depth of the fall in the first quarter as deep as maybe a lot of people do. I think the Fed is closer to pivot and pause than they think. Their forecasts have been notoriously incorrect. I probably go 25 basis points in February, more for covering their ego, if you will, than the economy really needs it. But I think that's going to be the end. And as far as you look at the dollar and the S&P 500, they've been in an inverse correlation since August. And as the dollar has gone down, we've seen some pairing of losses in equities. I think that's going to continue into next year. And my two favorite currencies in G10 are going to be the Canadian dollar and the Japanese yen. They both, in the two-year space, the two-year sovereign spreads, when those spreads narrow, it favors both the Canadian dollar and the Japanese yen considerably. And it's like a puppy following its master. When those yield spreads narrow, the currencies, the foreign currency strengthen.
What could change your thinking here at this point?
I think, anything of black swan of sorts. The China comes back from New Year celebrations and the COVID virus spreads like wildfire. And they either have to shut down again or they're not able to produce goods that people need. And we get back into that supply chain bottleneck thing, and then inflation stays high. And the Fed, will maybe have to stay its course. But I think the Fed's walking a very delicate balance because we're about to, if that scenario plays out, I think it's going to be almost impossible to not have stagflation. And that is a scenario that only Paul Volcker was able to deal with. And I don't think this Fed is capable of dealing with it, to be honest.
So Vince, going back to what you said about the Fed, pivoting and in the next year, in 2023, only raising rates by 25 basis points at its next meeting, which is in February. I think the bigger question has to do with how long it holds rates where they are after that next 25 basis point increase. How long do you think that's going to be, and what do you think brings on some sort of cut, if anything?
I think that's really a good point. I think that is the point. I think the Fed thinks that they're going to keep it there for the balance of 2023. February will be the 100th change in the Fed funds rate since 1990. So in 32 years. If you look at the pattern of Fed rate changes, you'll see these really drastic moves to one way and then really drastic back the other way because, frankly, their forecasts are not very good. I would be willing to bet this forecast is no better than the ones in the past.
Yeah.
And if the economy rolls over, they're going to have to roll over interest rates a lot quicker than they think.
I am curious about your thoughts on volatility. I mean, we talk about, of course, the strengthening of the dollar, the weakening of the other currencies, but I think it was the volatility in between that scared a lot of folks, particularly not just those folks in the FX markets, but some folks, of course, in the bond and equity markets that had to sort of, tether themselves to a certain extent to that volatility. Do we get a repeat of that next year?
I think in the near term, yeah. I think for sure for the first 3 months, maybe the first 6 months, that volatility is going to be there. It's only going to pass if and when we see the Fed alter its interest rate course where there's a trend in place. So right now the trend has obviously been on the downside, but it's really choppy because there's still a bit of a battle between buyers and sellers. I think it needs to be a little bit more convincing as to, as your previous guest said, a buy market and that volatility subsides.
So a little bit earlier, Vince, you mentioned that you were kind of keeping your eye on the yen for a nice little rebound as well as the Canadian dollar. I'm curious what your thoughts are on some of the EM currencies because we did see some pretty decent performance in the final weeks of the year here. And there are a lot of people betting on this idea that we could see some sustained rebounds in some of those pairs in 2023 as well.
Well, I mean, if you see economies and global economies rebound, and a lot of the emerging market currencies, are exporting economies, and certainly you can see EM actually I would say even outperform Europe and potentially some parts of Asia, but certainly outperform Europe. I think the European situation, you still have the Ukrainian problem. You still have issues with highly imported inflation in the UK. So I wouldn't be betting much on Europe, either the euro or the pound.
Yeah.
And EM could really, really, really soar if this recession is a shallow one and the global economies pick up pace.
What's crypto going to do? What's the pair there? Is that like Aussie crypto, Aussie Solana?
You kind of
what do
look
I
like
do?
a crypto king in that chair, you know?
I think crypto, of course, it's certainly not my wheelhouse, but it certainly seems to be here to stay. Enough major investors have piled money into it. I think people will continue to put money into it, and any kind of rebound is just going to encourage more investment into it. I would be looking at the larger coins if you're going to be playing in that space, Ethereum and Bitcoin. I wouldn't go too far down the ladder of the minor ones that aren't well.
You're not a Doge.
That's what crypto people do. You got to go down the ladder, right?
You know, we have Dogecoin prices on the terminal.
You go down the ladder sometimes a lot faster than you think. That's the problem.
I mean, so you're telling me, so you're telling me I shouldn't have bought that golden retriever coin, right? Okay.
Yeah, there you go.
All right.
Oh my God. I asked earlier, Vince, what asset class, each of us are kind of watching for 2023. What is it for you? Is it currencies?
I think it's probably going to be more the fixed income market. Those folks are, when you look at the yield curve and the inversion, it's not inverted because they think there's going to be a major recession, although they do think a recession is coming. It's inverted because they don't believe the Fed's going to stay the course as long as the Fed says they're going to stay the course. So that's why if you got 4% in 2 years and something I forgot the last look today, was it 3.75-ish in the 10 years, and it goes out, the same story is out in the 30s and in the 5s. That inversion is basically the fixed income market saying, yeah, Fed, we know you're there. We have to keep 2-year yields closely matched to Fed funds, but we're not buying the story that you're going to hold it there for a very long time, and that's why there's that inversion. And when the Fed does pause, the rally in the 2 years is going to be fantastic because the yield curves in the back end are priced already. And the only part that's mispriced, quote unquote, if the Fed starts to roll over, is in the front end and is in 2s. So you'll see this massive rally in 2s and this back to a positive yield curve. The narrowing will take us back into positive territory. Most of the gains will come in the front end.
So could we see once again a correlation between stock movements and bond movements in terms of pricing?
Yeah, absolutely. Totally. And I think that's exactly what is going to happen. I think you'll see front end rates come down and stocks go up.
Hey, Vince.
And then that correlation with currencies will stay as well.
Jumping around, but doing this because we have you, and you pretty much cover everything at the Macro Squawk desk. You told me a few weeks ago that the consumer here in the U.S. is something to watch, and you use the term the consumer here is tapped out. What did you see from holiday sales, and then what can you tell us about how you're thinking about the consumer in the early part of 23, just in the last minute that we have with you?
Last retail sales numbers weren't that good, and I wouldn't even put too much weight on December retail sales. We're back in, it's the holiday situation. I would look at retail sales first for January and February. I'd look at wages for January and February, see if in any way, shape, or form they're trying to catch up. And I would look at savings versus disposable income because that's been declining. And if that continues, there's just nothing the consumer has left. Revolving credit is too high.
Yeah.
Vince, just tell us, are there little arms attached to that chair that come around and kind of give you a big hug?
They
come
don't
on.
come around, but there are arms. I'm leaning on them. But it is a proper gamer's chair. So if I wanted to actually recline completely, I could, but I don't.
All right. Well, we love you so much. Happy New Year. And we'll talk to you certainly in 2023. Vince Ignorella there.
All right. You know what we're going to talk about coming up next? Fitness. A lot of people are ready to make their New Year's resolutions.
Yes.
We know we always see this pretty big bump here for a lot of these fitness companies. We're going to talk to the CEO of Orange Theory Fitness, Dave Long. You're pretty fit, Tim.
I got to do some Orange Theory in the new year.
This is Bloomberg.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
We've made it almost 2.5 hours, and we haven't yet talked about Southwest Airlines. It's certainly one of the biggest stories of the week. Madison Mills is here with us. She's been covering this story throughout the week today. And Maddie, I think one of the reasons we haven't been talking about it today is because, well, the company's kind of getting back to normal with its flights. Give us an update, because we learned late yesterday that they were planning for a, quote unquote, normal Friday.
A normal Friday, and that's exactly what they had. I do have to bring up the number, though. More than 15,700 flights canceled over the course of this week. CEO Bob Jordan this morning, though, saying that all aspects of the airline's operations are going to be examined. He said that this afternoon, actually, and said the company is sparing nothing in its operations review following that post-Christmas meltdown that we've been talking about all week. He confirmed that he's going to scrutinize the network, including the point-to-point system we've been talking about, but then clarified that's likely to stay in place. The real issue is the technology and investment in that technology.
All right, so there's obviously the business story, what happened with the company logistically or didn't work this week. And then there's the share price story, because this stock was under a lot of pressure this week.
Yeah, I mean, I think it was 2 days of their biggest slump since June of 2020, down 11%, then getting a little bit of correction there. Obviously, nobody's having a great day on the markets today, but I do think that Southwest is hoping to maintain that great balance sheet that analysts love heading into 2023, especially because they're going to use this to really offer a lot of discounts to travelers.
I am curious, though, looking forward, because remember, I don't know, it was a couple weeks ago, JetBlue kind of warned, they didn't really give a forecast, but they basically said that some of the trends they saw heading into this holiday season, where you typically see an uptick, weren't quite as strong as they had anticipated. And then we heard some similar comments from a couple other airlines here. And I wonder if the bloom is off the rose, that all that revenge travel, all the stuff we were talking about here in 2021, if that's it, we're basically tapped out and we go back to whatever the old normal was.
I think the biggest thing for 2023 is going to be international travel, and people might have been staying home for the holidays in anticipation of big international travel in 2023, especially because of the strong U.S. dollar, right? This is a great time to go to Japan, to go abroad.
Well, for now, we were just talking to Vince Signorella. Apparently, that may not last. Maybe that'll get people to travel here.
Yes, fair enough.
I get your point.
Yeah. And I think that international is going to be the big thing. I did a story in the fall that's a little bit silly, but it was about millennials who are tired of traveling because all of their friends had weddings that were postponed during COVID and rescheduled this year. I don't want to get on an airplane again for a long time, I gotta say. So that might lead to a decrease in travel as well.
You know, it's interesting, too. I was looking at a Bloomberg opinion column that just said, this company kind of got away from its core in terms of listening to employees. We talked about Herb Kelleher earlier in the week that, if they might have fended off some of these problems. And as you talk about, they're going to tackle some of these, but you do wonder about thinking about what the culture is and just listening to the folks that are actually working at the company.
Well, and it does seem like there is still a lot of goodwill for Southwest. I did a TikTok about everything we've been covering, and a lot of people who were having canceled flights were really upset. But I got a lot of comments from people who are so defensive of this airline because they are lifelong Southwest fans. They love that they get to pick their own seats. I'm amazed by that.
You're a big Southwest guy, right?
Well, I used to be, but I mean, it had a big presence in Chicago, where I'm from, out of Midway Airport, and it was convenient, and it was, but this was years ago. I'm not going to date myself, but it was a convenient airline. It wasn't just that it was cheaper, but the whole process was just a lot easier than the other airlines. But things have changed. Let's just put it that way.
Yeah, I mean, of course, you're all going to have your favorite airlines, but, crisis managers, communications managers, a lot of the folks that we've been talking to say that as long as the CEO continues to take full responsibility for this, which he has done in all of his messaging, Southwest could see recovery heading into the first quarter of 2023 even.
I got to say, here's the deal. I mean, if they kind of don't have any more problems, we're going to stop talking about them and we'll move on. That's for sure. That's how it goes. Thank you so much for all of your coverage of this story. It was an important business one and market one, certainly this week. Our thanks to Madison Mills joining us here in studio. All right. Can we talk about getting in shape?
Sure.
I'm ready.
Let's do it.
You ready? Getting in shape, more active. We know it is certainly...
I hate when Carol takes these digs at me. But sure.
You're in fairly good shape. Getting in shape and more active is certainly something people think about at the end of the year. I kid, because I love. One company hoping to attract more customers and expand its presence is Orange Theory. You see them around the country. It's the gym that fuses digital technology with physical fitness. And joining us now for more on his outlook and the business and what's going on in the fitness industry is Dave Long. He's the CEO of Orange Theory Fitness joining us. David, it's good to have you here. We do have a lot of individuals, including those around this table, probably thinking about, all right, what better can I do in the new year for myself? Tell us what you guys are seeing in terms of your business. How busy are you? What's the demand? Give us some thoughts on that.
Yeah, it's great to be on it. It's been a couple years since we've been this excited about going into the new year. And, I think what we're really seeing is we had a much busier kind of fourth quarter, which is usually a slower time, as people are doing all types of holiday things. But as we ramp and go into January, everything we're hearing from, current members, former members, and a lot of people that we believe are just going to enter the in-studio fitness market next year, all the indicators show that 2023 is going to be a banner year of people really getting back into in-person fitness, which I think many people are realizing is a huge benefit over other ways to do it.
We certainly saw people return to it in 2021 and also in 2022. I'm wondering, with the 1,500 locations you have in the U.S. and around the world, you have 100 new studios planned for 2023. You opened close to 100 this year. What are you hearing from franchisees right now in terms of challenges that they're facing? Are people starting to say, wait a second, this is discretionary spending. This is getting expensive for me to do this, and I'm feeling squeezed in other areas of my life. Are you hearing that from franchisees?
And not necessarily. I think it's very interesting in that when a consumer comes to the realization that they need a specific type of fitness with the community and the accountability that we offer, and we provide, such a great benefit in the way that we deliver programming throughout the world through, 6,000 unbelievable coaches. When we kind of dial into that, it's really not so much about the cost as it is about somebody making a commitment to doing it and knowing that if they're going to sign up for classes and commit to a membership, they're going to go. And it's a great accountability measure for them to go. That's most of what we were seeing. We actually went through some small price increases throughout 2022 as we had been holding prices for a number of years. Mm-hmm. So we're really not seeing that. We're really just seeing it slowly, the layers of the onion peeled back of more consumers coming back to in-studio, and a lot of new people entering the market that had never been to a studio or a gym before.
So with regards to the price increases, what was the reception that you saw, I guess, in aggregate here? The general idea was people were willing to take it?
They were. So, as you can imagine, we measured attrition and kind of response to that very closely and saw almost none. And again, the folks that are engaged with the brand and working out regularly in the studios responded really well.
Talk to us a little bit, though, about staffing. I mean, this has sort of been a challenge for any business. I mean, obviously not just fitness. But, I mean, in order to do these, I mean, you obviously are very... I guess, steeped in technology, but at the end of the day, there is still a human element to this. And I'm wondering what type of challenges you have had in making sure that all of these locations are staffed properly.
Yeah, so, you can kind of split it like, front of the house. We continue to really modernize all the systems that our front of the house employees use to really focus on them having fun in the studio and engaging because, the competition for labor is real and continuing. And then we think of what brings the whole workout to life is this unbelievable coach that we have. We have 6,000 of the best in the world. We're actually calling next year the year of the coach, where we're also provide really enhanced onboarding and training that a coach can use throughout their career. We're enhancing that and providing even more benefit as we go into next year to really be the marquee place for, a professional personal trainer who want to come and, make a living and impact a lot of people versus one-on-one training. Our coaches are impacting hundreds and hundreds of members throughout the course of the week.
So, Dave, I've got to say, one of our producers, Will Shaker, coming in with some cute little questions, and he says, how many people sign up and do nothing? And I feel like I've got a Peloton at home, and my husband's like, could you get on it? Because we're paying every month for you to use it. And he's not wrong, but I do wonder how many people have good intentions, they sign up, and then ultimately don't show up.
It's a great question, and it's really the cornerstone of how we built this business is on a local studio community. And so as soon as somebody signs up to be a member anywhere at any studio, we're working with them to pre-book their classes and pick their times. And if they're missing a class, as you can imagine, we're in a nice way encouraging them to come in. So we're a bit of the anti-gym in that we want our members to work out consistently, at least right. Twice a week. 3 times is even better. That's been really successful for us. And also at our price point, if people aren't coming regularly, obviously they're not going to see the value in it. So it's really on us to get them into that habit very early on. So right at time of signing up, a person needs to say, I'm going to come Monday, Wednesday, 5:30. Those are my times, non-negotiable. And when people get into that habit, they stick with us for a long period of time.
Well, and let's go there. I mean, first of all, your demo. What is your big demo in terms of who actually signs up and works out with you guys? And then once they do sign up for a membership, you said it's sticky. How many tend to say, okay, I'm going to do it for another year. I'm going to keep going?
Yes, our demos is pretty broad, but the core of it is kind of that 20s to 40s professional that works heavily, finds either early morning or after work or even a lunchtime class or weekend classes to get in. And then what we see is our typical member stays for, on average about a year. Mm-hmm. But what's interesting is they might leave for 6 months, but a high percentage of our members, a lot of times over 30%, they end up coming back. So they take a break and then they come back because they remember the type of results that they got in the studio and they want to get back to that feeling and those results.
Hey, David, give us some idea of your business. It's a private company, so you don't have to share these stats publicly, so we don't get them. But I mean, what can you tell us about revenue growth and also what the end game looks like for you? I mean, do you have an IPO on the horizon?
We don't. I mean, we're so focused going into 23 on our end user, our members, and in supporting our franchisees. I can say that we're right on the cusp of having our best year in system revenue, so the revenue that our franchisees are generating around the globe, which is super exciting.
Are you profitable?
We are.
All right. So it's been a good. I know it's been bumpy because COVID was tough, but are you back to pre-COVID levels or beyond pre-COVID levels?
In aggregate, we're very close. There are markets that you can imagine that are above, and then there are those that are lagging. But when you kind of roll it all up, we're very close back to being the pre-COVID levels. And as you can imagine, 2020 was the toughest year. 21, we got a lot of growth back. 22, another chunk of growth, and then 23 is really our year to kind of exceed all things that we had done in the past, which the whole organization is really excited about.
All right, so you don't have to, you're not tapping the public markets, but Dave, do you have enough money in terms of any kind of expansion plans or any kind of investments that you want to make going forward? No worry about access to capital for 2023.
We don't. Our growth is from new studios, comes from our franchisees, and a lot of the growth next year is going to be a combination of building on this huge domestic base that we have, and then a lot of international markets that are already fully recovered are starting to add new units again, which is exciting. And then internally, we're still reinvesting a lot of money into our proprietary technology platform, all the heart rate monitoring and special things that we do to customize the experience for the members. And then this year, the coach that I talked about. So really, it's focusing on improving the experience for the members, which is really how we win.
The pandemic was really interesting for sports. I mean, I started taking my yoga teacher at home virtually. I mean, it just opened up a whole wide world. The Peloton, right, took off in a big way. We see Peloton a very different world, certainly this year. So how do you think about fitness, the impact of the pandemic, what stays with us going forward, or what stayed with you guys going forward as a result of it, or nothing perhaps?
It accelerated, obviously, all the digital offerings, and we had been tinkering with a lot of digital offering, and really like how do you round out your wellness week? We think it's really good. Like above all, we want people to get moving, and we know that getting into the studio a couple times a week provides unbelievable results. But there's all those other days that people should be filling in with something. Could be yoga, could be zone 2 cardio, things that are really going to round out their fitness and their wellness. So we think this kind of advancement of what you could call the hybrid in studio and out, quite honestly, should be better for more people getting fit and getting the results that they want. So we're a fan and supporter of it. We know that our members need to come into the studio, X number of times a week to really hit those peak results, and then they fill in the other days. And we help them do it too through recommendations. They fill in those other days as they need.
All right, well, great to check in with you, and Happy New Year, Dave Long. He's the CEO of Orange Theory Fitness, joining us. We really appreciate it. Take care, Dave.
Happy New Year. Thanks so much.
Same to you. All right, folks, coming up.
The moment you've been waiting for the week.
It's like how I like to wrap up a week, a nice glass of wine. But we actually have someone who is a sommelier, very much knows the wine industry, but also is helping others based on his own personal experience, helping others to have a better life. So looking forward to that. You ready for that, Romain?
I am. It's the only reason why I agreed to do it this week.
Is that all about that wine on Friday at 4:45?
You are listening and watching Bloomberg Markets. Carol Massar, Tim Stanovic, and Romain Bostic, the reluctant Romain Bostic. This is Bloomberg.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
All right, everybody, the perfect way to wrap up certainly this trading year and this day, the global wine market. We're going to talk about it because the size, roughly $489 billion in 2021, estimated to achieve a market size of more than $825 billion by 2030. A lot of wine, we know that. And our next guest knows the market well. He is the former sommelier of the University Club here in New York City. He's a restaurateur. He's also using his own experience to improve the lives of others. We are so delighted to have with us Yannick Benjamin. He's sommelier, as we said, co-founder of Wheeling Forward, which works with and help really recently disabled people who lack a support system and resources to obtain the services they need. He is the co-founder of Wine on Wheels, Contento Restaurant. So much you do. Welcome, welcome, and almost
thank you for
Happy
having
New
me.
Year.
Such an honor, yeah.
You know, it is good to have you here. We're going to talk about all of this. It's something Romain has been talking
I've been
about
looking forward to it.
all week. Tell us about your organization.
Yeah, so Wine on Wheels was started about 10 years ago. I was injured in 2003. I'm a paraplegic. I was in a car accident.
You were a runner before. You're really active.
Super active, very physical. And, you know, what we noticed, or I noticed along with the co-founder of the nonprofit, is that there were other individuals in the same rehab unit, and they just weren't getting the same love, care, and support as we were. And so we said, what do we start an organization where we act as a secondary family, where we provide them to help them achieve their objectives, and they're not like the forgotten people. And so that's the population that we really focus on. It's really just being able to use our resources to help others that have less.
And your restaurant, or at least the newest restaurant,
Yes.
I mean, takes that to heart there. I mean, the way you built out that restaurant,
Yes.
it is designed to make sure that it is all-inclusive.
100%. The name of the restaurant, Contento, it's up in East Harlem on 111th Street. And, you know, counter seating, so it means that all of us can all go to the bar together and we're all looking at each other eye to eye, which is really nice. So there's not this like I'm looking up at you. And I think that's really nice. We have adaptive flatware for those that have, you know, neurological issues or they're arthritic with their hands, and they're beautiful flatware. So that goes a long way, and menus in Braille. So just those simple little things, you know, it really empowers people and makes them feel really safe and comfortable to go to a place where they go, oh my God, I'm provided with the resources to have a great dinner or lunch with dignity.
Feel like they belong.
They feel like they belong. That's exactly right.
Is New York City an accessible place? I mean, you think about it from the perspective of the subway, right? Right. And how few subway stations here actually have elevators?
I mean,
The reason I ask is because this is in New York City.
Yes.
It's a place that I think many people would say is, well, accessible in some respects, but not in many.
Well, just to give you perspective, I live in the Bronx. I live a couple of blocks away from Yankee Stadium. And the two closest train stations for me to get here to the studio, there's the one on 51st in Lexington, and then there's the one on Columbus Circle. I got off on Columbus Circle. I'm very blessed and grateful that I have the physical capability to roll myself over here and all that, but it could be certainly challenging. Or what if I got off that station in Columbus Circle and the elevator is broken, which happens, and not everyone is brave enough or crazy enough like me to take the escalator. But yeah, certainly, listen, New York City is still one of the greatest cities in the world. I'm born and raised here, but there's still a lot of work to be done. I would say that now we do have a lot more wheelchair accessible yellow cabs. Uber now, you can actually order a wheelchair accessible van where you can just roll in. So there is improvement that's being made. But yeah, we still have a lot more work to do, that's for sure.
What could be done more and better?
Well, for sure. I mean, listen, we have about 100,000 people just in Manhattan Island that are full-time wheelchair users, right? And I think, you know, just simply like curb cuts. Everything, every city block, every corner should have a curb cut. I can't tell you the amount of times when it snows, right? I'm waiting for the bus, but guess what? When they piled all the snow, so now the bus driver can't pick me up. So again, just having more self-awareness.
Something we take for granted, right?
Well, but you know, listen, I was a non-disabled person up until the age of 25 years old. But even I wasn't aware of those things, and it does take time. But I do see that, like, especially with this next generation, you know, the inclusivity, the intersectionality is really happening more and more, and it's a really great thing. But certainly we can speed it up more.
When we talk about the idea, and I'm told we are going to get to wine at some point here.
We better be.
In all seriousness, though, we talk about sort of what makes a restaurant the gathering place. We talked about, during the pandemic, we had so many discussions about how the closure of restaurants, for a lot of us, kind of destroyed the community, because these restaurants, for a lot of us, are our community, the local places where you can go and you can meet with people. So to have a place that is inclusive, where you can bring all your family members and everyone there can enjoy wine, food, whatever else, that's obviously been a big part, I think, of what has made Contento so successful. And I've been there. I should just full disclosure, I've eaten there. It's a great place. And but also, I wonder if you're starting to see other restaurants sort of, I guess, get hip to this idea.
For sure. And I've had other restaurateurs and other people in the business reach out to me asking for advice and, oh, where did you get your menus in Braille? Or what could we be doing better? I mean, which is a great thing, because we don't want to be known as the first and only restaurant that's, you know, taking this initiative. And the most important thing is not to be the last one. Right? And so please, by all means, every restaurant, any business, copy us. By all means, that's what we want. And listen, you know, if you can't get emotionally incentivized, financially incentivized, I'll give you some numbers. There's over 61 million Americans that have a disability, right? That means that's 1 in 4, which is a huge number, right? And within that population, there's over $500 billion of spending power. And so at Contento, we have been able to prove you'll come there tonight, and there's Peter Slayton, a very good friend of mine, who's part of the blind community, and he's got his guide dog, Inga. We've got a couple of wheelchair users, so on and so forth. And they're coming there because they know that our staff is trained, there's empathy, but there's love, and that goes a long way.
You gonna expand?
Yeah, well, that's the goal, of course. I mean, I just opened up a wine store on 47th Street in 10, so that's already keeping me busy with my wife.
So let's talk. So what do we got here? What do we got here?
So we have, listen, we're, holiday season, bubbles, sparkling wine. We have 3 different styles of sparkling wine, so I think it's a great example. We're going to start from right to left, actually. So right over here, you're right, and then, yep, so we're going to start off with the Prosecco, the Zardetto right here.
I love this Prosecco.
It's, listen, this is
you've already had this.
Cheers. No, I want
cheers to you.
But tell us what.
Yeah, so very simply,
Zardetto?
Yeah, Zardetto, exactly. So we're in northeastern Italy, right outside of Venice. And by the way, these vineyards in this part of Italy, we don't talk enough about them. They're absolutely gorgeous. It's breathtaking. So you should definitely go check it out. This is made from the Glera grape. So this is a sparkling wine. It's not a champagne, but a sparkling wine that you can use if you wanted to do bellinis, mimosas, do cocktails with, or just drink it on its own. Versatility is the key here, and it's incredibly affordable, and it over-delivers for the price.
All right, I'm hearing that we have about 3 minutes.
It's a sparkling wine. And so this is Italy.
Yeah.
This is also sparkling.
Yeah. So
is this from Spain?
So this is from Spain. Okay. Now we're in Catalonia. Okay. So we're right outside of Barcelona. Okay. And the grape here is called Macabeo. A bit more creamier, a bit more intense, higher acid, more on these kind of apple notes to it. And Cava is a designated appellation only used for
drier.
Spain. It is dry. Yeah. Oh yeah, gosh,
drier.
Bone dry for sure.
What is this, Los Dos?
Yeah, Los Dos is the producer. Yeah, and so wonderful Cava, about $13. You know, wine.com, Drizzly.
That's the only thing I find, that you can find really good things to drink that are very, very affordable. I think we used to think we have to spend so much money, right, for a good bottle of wine.
Winemaking is at its highest level right now. I mean, it's very hard to find a bad bottle of wine, to be honest with you.
What do we got here?
So Parigot is a producer. The name of the wine is Monochrome. Parigot is a producer, 5 generations. 100% Pinot Noir. This is a Crémant, so done in the same style as Champagne, but only done in Burgundy. So it's out, but it's still French. It's a rosé.
Right?
Yeah, it's very soft and creamy. Yeah, for sure.
Yeah, it's interesting. Earlier this year, we went out to the Champagne region in France, Renee, and we got to try. It wasn't this quite thing, but there's a lot of different types.
Yeah.
Because we're so used in the U.S. to kind of just it's either really sweet stuff, really dry, and there's so much in between.
There's a lot of different styles, and I urge everyone to try them out for sure.
What's interesting with champagne, too, is I think it used to be like a celebration, right? A celebratory moment. But I find you go to a bar and...
Now it's just brunch.
No, it is. It's exactly the case.
It's true. It's true. You're 100% for mimosas.
I feel like we have so much to be grateful for.
Yes.
Sorry, it's not because I've had 3 little sips, but I am a cheap date. But when you think about looking forward, what are your hopes for 2023?
Well, from a personal standpoint, it's definitely put my, my frustrations in check, So, taking the pause, that's the key. Taking the pause, and again, certainly, gosh, these last 2 years, between, the struggles of opening up the restaurant during the pandemic in 2021, then the wine store. I'm so grateful to have the wine store in the same building that I was born and raised in, with my parents living right above it. So I get to see them every day, and I'm the luckiest person in this world, in this universe.
A lovely legacy. Well,
and we're lucky to have you
thank
here
you
today. This
I'm
is,
very
I
blessed
think,
to be
a great
here.
way to end the week, great way to end the show.
Yannick, thank you.
Thank you.
So appreciate it. Yannick Benjamin, of course, sommelier, co-founder of Wheeling Forward. Check them out. You can find them online. Guys, that's a wrap.
Cheers. Cheers to 2022 and hopefully much better 2023 for us.
Yeah, exactly. Thank you.
And of course, to everyone who watched us all year long, we really appreciate your viewership. You're a big part of the reason that makes Bloomberg TV what it is. We'll be back in 2023. Please join us then. This is Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent